Friends, good morning again. Let us start with the session straight away. We are going to cover marine introduction. So marine cargo, hull and aviation. Cargo will be having more importance. Almost 18 to 19 questions will be coming from cargo and 5 to 6 from hull and 5 to 6 from aviation. So your emphasis should be on marine cargo. So in the class also, we will allot more time for the cargo and we will finish the aviation and hull in the afternoon. Okay. Marine cargo is the oldest form of insurance. It is actually the first branch of insurance in general insurance. It started in 17th century in UK. Now it has two broad classifications. One is cargo and another one is hull. First, we will see cargo. Cargo insurance covers export and import shipments, coastal shipments, shipments by inland vessels. Here afterwards, wherever the word vessel comes, it means either boat or ship. So shipment by inland vessels means the boat or ship which is sailing in the inland waters, not going to the mid-sea. Consignments by road, rail and air. Consignment by post. Consignment by post also can be insured. History of marine insurance. In 17th century, started in Lloyd's Coffee House in London, where the merchants met. The marine insurance actually started in a very informal way. There were no insurance companies, no policy was issued. But the merchants who were sending the goods by ship to other countries used to meet at a coffee house called Lloyd's Coffee House in London. And at the point of time, the communication facilities were not there. Suppose a ship is sailing from London, it has to come back after the given time. If it is not coming back, means it has been lost. So the merchants felt there should be some method of compensating these losses. Therefore, they started an informal arrangement of collecting a small money from all the traders who were sending the goods. From the pooled money, the losses were compensated. Exactly the same insurance principle was followed, but there were no insurance companies and no physical policy was issued. It is only an informal arrangement that was developed into the insurance company in a later stage. So marine cargo is the first form of general insurance anywhere in the world. Policia. Policy, the root word is polisa, means promise, which is the root word of the word policy. Polisa means promise. By issuing an insurance policy, we are doing nothing but we are giving a promise to the insured to compensate in the given circumstances. In 1720, 2 marine insurance companies were allowed by the UK Parliament. Thereafter, when other modes of transit were invented, added to the marine insurance. At that point of time, ship and boat were only the modes of conveyance. Thereafter, other modes were invented like steam engine, then automobiles and aircrafts. Everything was added, but still we call it as marine insurance as the tradition stands. In all other forms of insurance, who can take insurance? Either the property owner or the financier. In marine insurance, it is little bit different. Either the buyer or seller can take a policy depending on the sale contract. Banks, clearing agents and carriers can take a policy. Banks, as they have financed for the goods, they can take a policy. Clearing agents, the agents who are taking possession of the goods and making arrangements for the transit. And when the goods are delivered at the destination, again the agents, they are taking delivery of the goods, and for the forward transit, they take care. So they are called clearing agents, clearing or forwarding agents also. When the goods are in their possession, if something happens, they are responsible. So they can take a policy for the goods. When the goods are in their possession, carriers also can take a policy. Depends on the terms of the contract. Types of contract. Since marine insurance is involved in transit of goods, we should understand the main rules of the sales contract, because it has an effect on our claim settlement. There are many types of sale contract. FOB, free on board. Free on board means it is the responsibility of the seller to manufacture the goods and make arrangements for the goods to reach the port and put it on the board of the ship. Till such time, it is the responsibility of the seller. He has to arrange till the goods are reaching the board of the ship. So up to that point of time, he has to take the insurance. After that, the buyer has to arrange for insurance. Free on rail, same thing when the goods are going by rail. C&F, cost and freight. The invoice of the seller will have two components. One is cost and another one is freight. Freight means the amount which is payable for the transporters. Even now in C&F contract also, the insurance is not mentioned. So still taking insurance is the responsibility of the seller. CIF, cost, freight and insurance. Cost, insurance and freight. This is the widest form of sale contract where the seller takes the responsibility of the insurance till the goods reaches the last port on the destination country. Incoterms. International commercial terms. The abbreviation is Incoterms. All other general insurance policies mostly connected with the Indian soil. It is valid only when the insured is within India. But marine is of international character. The goods are moving from one country to other country. So all the countries should use the same terms or same nomenclature so that there will not be any confusion or ambiguity in a future date. For that purpose, Incoterms were created. As I told you, it is international commercial terms which indicate the rights and obligations of the buyers and sellers. International commerce terms to give uniformity and clarity. When the same name or nomenclature is used throughout the world, there will not be any ambiguity. It will be clear for both buyer and seller. Initially, there were 13 Incoterms, which was released in 2000. That was removed in 2010 when 11 Incoterms were introduced. Now there are only 11 Incoterms which came to effect from 1/1/2011. So from 1/1/2011, throughout the world, universally, entire this commerce is taking place based on this Incoterms. We will see what are the important Incoterms and their importance. X works or X warehouse or X factory. Abbreviation is EXW. In this form of sale contract, the buyer has to take goods from the doorstep of the seller's factory. So buyer has absolutely no responsibility. since the seller is coming to the doorstep of the seller, and he is taking delivery after paying for it. So the entire responsibility lies with the seller. Free on board. Free on board means, yes, we have seen the free on board is the responsibility of the seller till the goods reaches the board of the ship. But Incoterms is giving a small technical clarity on free on board coverage. So free on board covers till the goods pass ship's rails. That means rails means the equipment used for loading the goods into the ship. So till the goods are crossing this equipment or crossing the loading facility, it is the coverage given under FOB. So the goods are reaching the board of the ship. But cost and freight, CFR, which is called as CFR. Normally we call it as C and F, but Incoterms for C and F is CFR. CFR covers till the goods reach the ship's rails. So FOB gives a little bit more coverage than CFR. In CFR, the coverage is only up to the time the goods reaches the ship's rails. Cost, insurance and freight. As I told you, it is the widest form of sale contract where the entire thing is taken care by the seller. So the invoice itself will have a cost component, insurance component and freight component. So basically the buyer will pay the insurance component, but the responsibility of taking insurance lies still with the seller. Okay. So seller has to arrange for insurance, but a question arises, what insurance, to what extent? So Incoterms clearly says the seller has to arrange under CEF a minimum of ICCC, a minimum of ICCC. So the coverage should be minimum ICCC, and also the coverage should be taken minimum up to the last port in the destination country. Minimum up to the last port in the destination country. Warehouse to warehouse also can be given from the point of seller to the point of buyer, but Incoterms says the minimum requirement. Minimum requirement is ICCC coverage from the seller's point till the ship reaches the last port in the destination country. If the insurance is arranged only up to last port by the seller, then the buyer has to arrange for the inland transit from the port to his place. But normally in CF, it is the minimum requirement as given by the Incoterms, but normally we cover in CF cover from warehouse to warehouse basis. That is from the point of the seller to point of the buyer. DDP, delivered to duty paid. Goods to be delivered at the doorstep of the buyer, just opposite to the ex-works. Here the goods are delivered at the doorstep of the buyer. So entire responsibility again comes to the seller. So what is the difference between CEF and DDP? In CEF, the seller has a choice whether to give the insurance coverage up to the last port or up to the buyer's place. He can give up to buyer's place, but it is only his choice, not compulsory. But in DDP, the goods has to be delivered at the buyer's place. So entire responsibility lies with the seller till the goods reaches the buyer. DAP, delivered at a place. Goods delivered at an agreed place by the seller, maybe short of the buyer's place. DAP means it need not be the buyer's final destination. It may be any intermediate place before reaching the buyer's place, but it is the agreed place between the buyer and the seller. DAT, delivery at terminal. Seller will deliver the goods at agreed port terminal after unloading. So the goods are delivered to the buyer immediately after unloading the last port. Then buyer has to take insurance for the remaining part of the voyage. We have to understand how a trade takes place. Importer open a letter of credit with a bank in favor of the exporter. Importer means buyer. Buyer opens a letter of credit with a bank in favor of the exporter, the seller. When goods are ready, the exporter hands over the title of goods and bill of exchange to the banker. When the goods are ready and put them on transit, and the seller gives the title of the goods and bill of exchange to the banker. So he gets money from the banker. Naturally, now the banker will become the owner of the goods, because he is having the title of goods and all the documents regarding the transit of goods. So that will be the guarantee the banker is getting against the money they have advanced. But something happens during the transit, the banker will be at loss. So as a further security, further guarantee, they take the insurance. Importer may not make payment if goods are damaged. So if the goods are received in a damaged condition, the buyer may not make payment at the time. Only the insurance will come to the rescue of the financier or banker. Marine Insurance Act. Actually, it is the only act exclusively made for some part of the general insurance. All other acts are relevant to general insurance, but not exclusively for general insurance. For example, Motor Vehicles Act, it has a part called how the insurance should be given for automobiles, what should be the responsibility of the vehicle owner and all. Only one part deals with the insurance. Remaining parts deals with the registration, driving license, permit, everything. Like so many acts. But Marine Insurance Act 1963 deals exclusively with the insurance of the goods. So it is the only act which deals with exclusively a particular branch of general insurance. It is more flexible. Actually, it is giving the basic principles and responsibilities of buyers and sellers and the carriers, how a claim should be settled, all the details they are giving. But with a rider which states that it gives the responsibilities, duties, everything, the rider says unless otherwise as specified in the policy document. That means the wordings in the policy document is overtakes the terms given in the act. So you can modify the guidelines or terms given by the act by modifying the policy wordings, policy terms and conditions. So it is more flexible. It is not rigid, just like Motor Vehicles Act. Motor Vehicles Act gives rigid principles. You have to cover minimum this much and how the claims are settled. Everything is rigid. But in Marine Insurance Act, it is most flexible. You can modify the terms given in the act by modifying the wording in the policy. 2 implied warranties are given in the act. What do you understand by warranties first? There are 2 terms regularly used: policy conditions and warranties. Policy conditions are printed on the policy. The breach of a policy condition will make the policy void. This is applicable for all general insurance policies, right? So when there is a breach of policy condition, definitely there is no claim. The insurer cannot make a claim. What do you understand by warranty? First of all, you understand what is a policy. A policy is just a promise given by the insurance company or insurer to the insured person, stating that in what situations he will compensate the insured. It is only a promise. So we are selling a promise and a paper. Warranty means the insured has to give a counter promise to the insurance company to keep the policy live. For example, in a burglary policy, 24 hours warranty, 24 hours watchman warranty is there. It is insured's duty to keep a watchman on 24/7 basis. It is a counter promise given by the insured to the insurance company, which makes the policy live, which keeps the policy live. Suppose there is a breach of warranty. What will happen? Suppose there is a breach of warranty, the insurance company will have an option whether to settle the claim or not to settle the claim, or settle the claim for a lesser amount on non-standard basis. So this is the basic difference between a policy condition and warranty. Breach of policy condition will make the policy void, but breach of warranty will make the policy voidable at the option of the insurer. Right? Okay. Now come to warranty. There are two types of warranties. One is implied warranty, another one is express warranty. The warranties which are printed on the face of the policy, they are called as express warranty because they are expressly stated in the policy. Implied warranties are one which are not printed in the policy, but they are applicable to the policy. Right? So there are two implied warranties in marine policies. One is seaworthiness and legality. Legality should be always there in for all the policies, because insurance is a contract. A contract cannot be made for an illegal purpose. So legality of the purpose should always be there to make the contract live. Seaworthiness. What is seaworthiness? The insurance company says that the insured should take care to carry his goods in the ships which are seaworthy. Seaworthy means they should be strong enough to meet the perils of the sea. So it should reach the destination without any problem. So that is called seaworthiness. So the implied warranty seaworthiness means if the goods are carried in a ship which is not seaworthy, then the insurance company need not make a claim, will not pay a claim. Again, since it is only a warranty, the option lies with the insurance company. It can pay a claim, it can reject a claim, or it can pay a lesser amount on non-standard basis. So there are two implied warranties, seaworthiness and legality. The seaworthiness warranty has been modified after this 2009 classes are implemented in our country from 2015. Now seaworthiness, earlier the unseaworthiness of the ship, even if it is not known to the insured, or even if it is known to the insured, we are not liable. But now it has been modified. If the unseaworthiness of the ship is not known to the insured, then we have to pay the claim. That is, if the insured is not able to know the seaworthiness of the ship, or he don't have any knowledge on the seaworthiness and sending the goods by that ship, we are liable for the claim. Right. I have given the section numbers. Normally they are not asking the section numbers. Anyhow, just go through which section deals with which principle of insurance. For insurer interest, utmost good faith, proximate cause, indemnity and subrogation. You just go through the numbers, but they will never ask the numbers. Okay. I told you marine is of international character. So to avoid ambiguity, to give more clarity, all the goods transits happening throughout the world should use a uniform set of terms and conditions. Then only there will not be any problem during the claim settlement. So for that purpose, the Institute of London Underwriters, which is the apex body at one point of time in marine insurance, they created one set of classes called as ICC classes, that is International Cargo Classes. That was drafted by ILU. Later on, ILU was merged with International Underwriting Association, ILU. So this ILU is now drafting the classes, the ICC classes. I want to give you a clarity on some of the terms which are used in marine insurance, because these terms are many times they are asking in the exam. A defeasible interest. Defeasible interest means the interest means insurable interest, nothing but insurable interest. The insurable interest which is coming to an end during the currency of the insurance policy by the occurrence of some event other than maritime event. That means the insured person is having insurable interest when he is taking the policy, but he is losing the interest or transferring his interest during the transit by any event other than maritime perils. For example, if suppose he is selling the goods when the goods are in transit and getting the money back, then he is naturally losing the interest because he don't have a financial interest on the goods because he has already sold it. So such interest is called as defeasible interest. Here no maritime peril has acted, but only a sale has happened. So because of sale, he is losing the interest. Such interest is called as defeasible interest. Contingent interest. Contingent interest means an interest which attaches during the currency of the policy on happening of a contingency. Just opposite to defeasible interest. There, the insurable interest is going away from a person. Here, a person is gaining an insurable interest during the transit. Just he is buying a goods when the goods are in transit. So that is called as contingent interest. Abandonment. What do you understand by abandonment? Abandonment is when the goods are either destroyed or damaged or still in the sea, but it cannot be recovered. In such a time, the insured, because he is having the policy, he may abandon the goods. Abandon means he will just leave away the goods and he will claim with the insurance company against the goods. But you should understand one thing. The insured will give a notice of abandonment. Of course, the claim is payable if the damage or loss is due to the insured perils. But the insurance company, once they are accepting the notice of abandonment, they are taking the rights, titles, interests, and also the liabilities which are attached with the goods. So normally insurance company, even though they are paying the claim, they will not accept the notice of abandonment. Suppose they are accepting means all the liabilities connected with the goods will come back to the insurance company, not it will be with the insured. Suppose there is pollution liability or the wreck removal liability. So everything, if it is accepted by the insurance company, then the liability is also coming with the abandonment. So abandonment means it is not transfer of not only the rights and titles, but also the liabilities. Next one, this one term, many times they have asked, even though this term is applicable for all the policies, insurance policies, many times they are asking this question only in marine. Contra preferendum rule. As I told you, insurance policy is nothing but a contract entered between two parties, insurance company and insured person. In all other contracts, both the parties to the contract will be contributing in making the contract, and both the parties will be signing on the contract. But in insurance policy, insurance contract, only the insurance company is making the contract, only the insurance company is signing the contract. The insured has no role either in making or issuing the contract. So suppose anything is ambiguous or anything is which is not clear in the policy terms and conditions, then the legal forums like courts always construe the term against the person who has prepared the document. In this case, it is the insurer. So, in case of insurance contract, when there is an ambiguity, always the term which are ambiguous will be construed against the person who has made the contract, that is the insurance company. Okay. In all other contracts, when insurable interest should exist to get a claim. In all other general insurance contracts, the insurable interest should exist on two occasions. Number one, at the time of taking the policy. Number two, at the time of loss. If a person is having insurable interest on both the occasions, then only he can get a claim. Take the case of a motor insurance policy. I have a car. Yes, on date I am the owner. I have taken a policy. After 3 months, I have sold the policy to B. But it was not changed in the policy document. Policy document is continued to be in my name. After 1 or 2 months, if the vehicle meets with an accident, I will not get the claim, because even though I have a insurable interest on the time of taking the policy, I don't have a insurable interest on the time of loss. The person who bought the car also will not get the claim, because he is not at all having a contract, because the contract is not changed into his name. So both the persons will not get a claim. This is applicable for almost all the general insurance policies except marine policies. In marine policies, the insurable interest should exist only at the time of loss. It is immaterial whether the person is having an insurable interest at the time of taking policy or not. The person who is having an insurable interest at the time of loss will get the claim. Okay. So because of this provision, there is one provision in the marine insurance which covers the goods already in transit and which are sold. Suppose the goods are in transit belonging to A. It has not still reached the destination. It is in the mid-sea. But A has sold the goods to B. Now B approaches the insurance company for taking a policy Assume there is no policy till now. So he is approached, B is approaching the insurance company. Normally, whenever the goods have started already, we don't start a new policy. We don't give a policy. So we refuse a policy. But for examination point of view, you should understand that there is a provision in marine insurance which is called as last or not last. We can give an insurance even when the goods are in mid-sea to the person B by attaching a clause called last or not last clause. That clause says, on the date of taking the policy, the insured persons do not have knowledge of the safety of the goods. He don't have any knowledge whether it is safe, secured, or it is already lost. If we don't have any knowledge, then we can give a policy. If he is already having a knowledge about the damage or loss happened to the goods, but he is concealing it the facts to the insurance company and getting a policy, by attaching this last or not last clause, since the insured having knowledge, then we can refuse the claim. So this is only for academic interest. From the examination point of view, goods already started and it is on its voyage, we can issue a policy by attaching a last or not last clause, wherein the insured is declaring that he don't have any knowledge about the safety of the goods. If the declaration is becoming false, then we can refuse the claim. So this is only for academic interest, examination purpose of view. Normally in offices, we are not issuing such policies. This type of cargo vessels we will cover in hull. Methods of packing. Because packing plays a very important role in the safety of the goods, we will see what are the types of packing. Corrugated boxes or cartons. Regular packing, what we see in the grocery shops. Wooden boxes, mainly machinery and machine spares are coming in wooden boxes. Bags, bales. Bales means like cotton bales. They are secured in a big bundle. Over and above that, some wrapping will be there by either by a cloth, over that by some steel wires and all. So it is called bales. Pallets. Palletization means the goods are placed on a wooden platform or plastic platform. So there will be a platform, over that the goods are placed and it is securely tied with the platform. The goods are securely tied with the platform. So whenever the platform is moved, the goods are going with that. Unitization. That means you are placing some units in a big pack, like 24 bottles are coming in a pack, like that. So unitization means you are putting the goods in given number of units in a single box. Lift van. It is being lifted. Nothing but it is normally machines and are carried by lift van. Bulk cargo without any packing, like coal and all. So it is coming without any packing. Containers. Nowadays the movement of goods is mainly based on containers, where the goods are stuffed into big containers and the entire container is moved, loaded or unloaded into the ship. As I told you, marine is peculiar. Marine is odd and out when you compare the marine policies with all other general insurance policies. We have already discussed insurable interest is important one. In all other forms of insurance, it should exist on 2 occasions, but in marine, the insurable interest should exist only at the time of loss to get a claim. Most of the insurance policies are based on indemnity. What do you understand by indemnity? Indemnity means you are making good the loss sustained by the insured exactly, not more, not less. In other words, you are keeping the insured in the same financial position just before the loss. That is called indemnity. It goes with the natural justice principle. No one should get a profit out of an unfortunate event like fire or accident. The insured should not get a profit out of an accident. So we are strictly following the indemnity principle in most of the insurance policies. But marine policy is issued on commercial indemnity. Commercial indemnity is again indemnity, but little bit more than the strict indemnity. Strict indemnity means you are paying exactly the loss. Here, you are paying little bit more than the loss. By the way, the insured is allowed to insure his goods for 110% of the invoice value. In all other insurance policies, this is not there. They should insure only for the exact market value or exact incident value. But here he is allowed to take insurance on his goods 10% more than the invoice cost. In case of a total loss, we have to pay 110%. We will not ask questions for the 10% extra. We are allowing the 10% because there are two reasons. One is it is totally a commercial transaction. All the goods having fluctuating prices. When the goods reaches the destination, the value of the goods might have gone up. Suppose the goods is lost during transit. The person who is buying it may end up with a loss which may be more than the invoice price. Because of that reason, we are giving commercial indemnity. It is only allowed in marine insurance. Assignment without the consent of the insurer. This is also an important area. What do you understand by assignment? There are two terms used in insurance policies for transferring the rights of the policy to some other person. One is nomination and another one is assignment. What is nomination? Nomination is the declaration made by the insured person stating who will be the person receiving the benefits of the policy in case he is not alive, in case the insured is not alive. In legal terms, the nominee is the person who receives the benefit of the policy only when the insured person is not alive. And again, the nominee is the person who is receiving the benefits of the policy or money of the policy as a representative of the legal heirs. That means he cannot keep the entire money with him. He should share it with the legal heirs. Suppose he is not doing so, the legal heirs may sue the nominee. So it is the duty of the nominee to share it with the legal heirs. Then the nomination can be changed at any point of time by the insured person. At any point of time, he can change the nomination any number of times. And again, without the consent of the existing nominee. Without the consent of the existing nominee, he can change the nominee. Okay. These are all the legal facts about the nomination. Now come to assignment. What is an assignment? Assignment is also a nomination, but which is irrevocable. That means once you have assigned the policy to a third party, a person, you cannot revoke it without the consent of the person to whom it was assigned. Hope you are understanding it. For example, we are taking a housing loan from our company. So when the company is giving loan based on the salary we are getting, suppose the borrower dies, the company is losing the repayment. So it wants a LIC policy taken in the borrower's name and it should be assigned to the insurance company. So whenever the borrower dies, immediately the company will make use of the LIC policy assigned to it and take the money and adjust it to the loan and give it back to the balance to the legal heirs. So assignment, number one, it is a form of nomination, but it is irrevocable without the consent of the assignee. If the assignee is giving consent, then you can change the assignment or nomination. Number two, nomination comes into picture only when the insured is not alive. But assignment is coming into picture even if the insured is alive. Suppose the policy matures, LIC policy matures, the insured is alive. Even then, the proceeds of the policy will go to the assignee only, not to the insured person. So these are the important differentiation between nomination and assignment. Okay. Now come to marine policy assignment. In all other policies, whenever there is a change of interest, like motor policies, the person who has received the insurable interest should come to the office and inform us and give the required documents, pay the required fees or premium. Then only the policy will be transferred to his name. This is applicable in all the policies. But in marine, as it is of international character, the buyer or any other third party who is receiving the goods, who is receiving the title of the goods by paying for it, cannot come to the insurance company and change it to his name. So what is the procedure? The physical policy is given to the original insured. Whenever the goods are sold to any other third party, the insured person will just write on the reverse of the policy that I have sold the goods to so and so person. So I am assigning the entire policy to him. That means from that point of time, whatever may be the proceeds of the policy will go to the other person only, not to the original insured. So this type of assignment can happen without the information or consent of the insurer. Even it need not be informed to the insurer. It automatically it is assigned to the third person. This assignment can happen any number of times. If A is selling to B, B is to C, C to D, finally now as on the date, D is the owner. On the time of loss, if D is the owner, we have to pay the claim to D only, if the proper assignments are made on the reverse of the policy. So this is one very big change the marine insurance has when you compare the other class of business. Recovery of stamp duty. In all other policies, the insurance company is paying the stamp duty, but here the insured is paying the stamp duty. Coverage of war risk. Yes, all other policies are valid within India. There is no need for war risk because marine is of international character. There is a need for covering war risk, and war risk is covered only in marine policy. There is no proposal form. As I told you, marine insurance started in the informal way. There was no insurance company, there was no policy, so there was no proposal form. Even now, the same tradition is followed. Normally, there is no proposal form for the marine cargo insurance. But how we will come to know what is to be insured? The insured has to give a request to the insurance company, giving all the details of the transit. the description of the goods, value of the goods, the carrier's name, and the source and destination. Everything he give in a white paper that will be serving as a proposal form. Okay, in policy form, as usual, all the details in other policy also here. Policy number, sum insured, premium, stamp duty, steamer. Steamer means the ship or conveyance details, voyage or journey details, bill of lading. Bill of lading means the bill of lading is the document given by the ship captain for receipt of the goods. For receipt of the goods, he will give a document called as bill of lading, which is the evidence of the goods shipped in that particular ship. Interest to be insured. Who is the interest to be insured? Classes attached, A or B or C. Claim settling agents. This is the one important factor which will be appearing in only marine policies. In all other general insurance policies, the claim will be settled by the issuing insurance company, but anywhere in India. The claim can be settled anywhere in India, but the company should be the same. But in marine case, the claim may be happening abroad where the particular insurance company may not be there. So the claim has to be reported to a claim settling agent. He will make arrangements for survey and survey report, and the claim settling agent will either settle the claim and get the reimbursement from based on the terms of the policy, and afterwards get the reimbursement from the insurance company. In other cases, the claim settling agent will make arrangement for survey fee and survey report, and he will send the survey report to the insurance company for making payment, for which the claim settling agent is entitled for a fee, and he will get it from the insurance company. Right? Attachments with the policy. Classes will define the coverage. What is A, B, C? The classes will define the coverage under the policy. Warranties, we have already discussed what are the warranties, and it will be attached to the policy. Important red slip. Red slip will give the procedure to preserve the rights of recovery. We will discuss in the claims what is recovery, what is rights of recovery. But the red slip means, actually originally it was printed in red when it was a schedule attached with the other classes. Nowadays, the policy schedule and all the classes forming a single document. So there is no red slip now, but the wordings are same. Earlier it was printed in red to give it in importance. The red slip gives what are all the duties of the insured when the loss happens, what the insured should do. We will see it in the claims. Cover notes, as in motor, here also there is a provision for cover note. Originally it is valid for 15 days, which can be extended for another 15 days. In motor, the period of validity of cover note is 60 days, here only 30 days. Okay, stamp duty. Again, it is very ambiguous. Each person is following his own rules. Each company is following its own rules for stamp duty. But as far as examination point of view, the associate book is the Bible. So whatever given the associate books will be the answer. I have taken this from associate book. So for examination purpose, you follow this, right? So stamp duty. Sea voyage, 10 paise for every 3,000 of sum insured or part thereof. For sea voyages, where the rate is 0.125% or less, 5 paise irrespective of sum insured. So first condition, first 10 paise per 3,000 is meant for the policies where the rate charged is 0.125% or more. You know, nowadays, not even 125. We are getting 0.0125 also we are not able to get. So normally the rate charged is less than 0.125% only. So we have to affix only 5 paise irrespective of the sum insured. Whatever may be the sum insured in 10 crores, 5 crores, whatever may be the sum insured, we have to affix 5 paise if the rate is 0.125% or less. If the rate is more, then you have to affix 10 paise for every 3,000 of the sum insured. So sum insured has to be divided by 3,000 and whatever comes you multiply by 10 paise, right? This is for the sea voyage. For inland transit, it is 25 paise when the sum insured is more than 5,000, 50 paise when the sum insured is less than 5,000. Sorry, 25 paise when sum insured is less than 5,000, 50 paise when sum insured is more than 5,000. So this is what given in the associate book. You go with this for examination purpose. ICC classes we have already discussed. So ICC classes devised by International Underwriting Association. It was originally drafted in 1982. It was effective in India from 1/1/1983, but it was revised in 2009, effective from 1/1/2009 throughout the world. But we adopted it from, I think, some of the companies in some different dates, but most of the companies are started using the 2009 classes from 2013. Now, as of now, we are using 2009 classes only. Okay. Now, we will see the actual coverage and what are the policies issued under marine cargo. First, we will see the sea voyages. What are all the policies or coverages issued for sea voyages? There are three types of policies. Policy C, B, A, ICCC, ICCB, ICCA, right? So ICCC is the minimum cover. Minimum cover issued for sea voyages. There are only 7 perils covered. Only 7 perils covered under ICCC. Most of the questions asked in marine are regarding the coverage, exclusions, types of policies, and some peculiarities assigned to the particular types of policies. So you should know thoroughly what are all the coverage and what are the exclusions. There is no choice for you. Whenever you want to attend for marine exam, you should be thorough with the coverage and exclusions, right? By heart, you should know. I will tell you how to remember. So first, there are only 7. C, ICCC, there are 7 perils. Fire or explosion. Okay, there is no explanation required. Number 2, vessel stranded. Stranded means it was stopped for some reason. Grounded means it has reached the bottom. Sunk or capsized. Sunk is different from capsized. Sunk means the boat or ship is going below the water surface. Capsized means it is still on the water surface, but it is upside down. Number 3, overturning or derailment of land conveyance. Overturning in case of road conveyance, derailment in case of rail conveyance. Number 4, collision with any external object other than water. Please understand, collision is covered by the policy. Collision with any external object which are external to the ship are covered. Collision with any object which is external to the ship is covered. But it is giving a rider stating that other than water. What do you understand? We have already discussed the seaworthiness. Seaworthiness means the ship should be strong enough to withhold all the perils of the sea. The water in the form of waves will strike against the ship. If the ship is not strong enough to face the waves, then it is not seaworthy. So very simple, when the ship is not seaworthy, we will not pay the claim, right? So when the collision with any other external object, it is payable, except when some damage happens just by the collision of the water waves with the ship. Okay. Number 5. Discharge of cargo at the port of distress. What do you understand by port of distress? It is not actually the destination port. In between, due to some reason, because of some exigency, the ship will go to a port called as port of distress. And the goods might have been there in the ship, but when the ship is not able to move further, the goods have to be unloaded and loaded to some other ship. So during this process of loading and unloading, something happens, also covered by the policy C. General average sacrifice. What is general average sacrifice? Many of you know what is general average sacrifice, but the technicalities. When some goods are sacrificed, some sacrifice is made to safeguard the entire ship and entire voyage. The sacrifice or expenses incurred are called as general average sacrifice. When the sacrifice or expenditure are incurred to safeguard only one cargo, then it will come as particular average, not general average. Particular average means partial loss of that particular cargo. So when the sacrifice is made to safeguard the entire cargo and entire ship, then the sacrifice made or expenditure done will be taken as general average sacrifice, which is payable under our policy. To what extent? Suppose the goods insured by us are sacrificed, we will pay the loss to the insured, and we will be getting the contribution from the other cargo owners and the owner of the ship. This is called as contribution. You should know why this is required. Suppose a ship is carrying some 100 cargo. Only one cargo belonging to the insured of us is in the top of the deck. When the ship is moving in the mid-sea, there is a storm. When the water is trying to come into the ship, the captain thinks only if the weight of the ship is reduced, we can save the ship. So what he will do? He will throw away the bulk cargo, which are heavier but which are less in value, into the sea. So the ship weight is reduced, the ship is saved. Okay. But who are all the beneficiaries of this sacrifice? The sacrifice was made by one only cargo owner. So that will be made good by the insurance company. So why other cargo owners or ship owners should bother about this? Forget about insurance. Suppose a sacrifice is made by a particular cargo owner to safeguard the other cargo on the ship. By natural justice, that cargo owner should be compensated by all the beneficiaries of the sacrifice. Who are the beneficiaries? Remaining 99 cargo owners and the ship owner. They have to compensate to this cargo owner who has made the sacrifice proportionately to the value of their cargo on the ship. That is called as contribution, right? Okay, now come to insurance. The cargo which is insured by us or sacrificed, we will pay the loss fully, and we will be getting contribution from the remaining cargo owners and the ship owners. The insurance company will be getting the contribution. Suppose the cargo insured by us are saved because of some other sacrifice, this insurance policy will pay the contribution to the other cargo owner. Very simple. So general average sacrifice works in two ways. When the goods insured by us are sacrificed, we will pay it and we will get the contribution from others. When the cargo insured by us is saved by some other sacrifice, we will make the contribution through the policy. Right? Okay. Now come to jettison. What do you understand by jettison? Jettison is nothing but forcibly throwing out of cargo. Then it is the same as general average sacrifice. Yes, jettison is one form of general average sacrifice. But general average sacrifice may include some expenditure of moving the goods, anything. But jettison may happen not to safeguard the entire ship, but also to safeguard only a particular item also. Suppose a food item. Let us take a case of vegetables or fruits, which started decaying because of the seawater damage. The entire fruits or vegetables are in a hold, and some of which are started decaying. If we are not doing anything, then the entire cargo, entire set of vegetable fruits will get damaged and will end up in a total loss. To avoid that, some of the vegetables and fruits may be thrown out. This is jettison. So jettison need not be a general average sacrifice alone. It can be for safeguarding a single cargo also. So jettison in this case, it is on a particular average, that is partial average of a particular cargo only. It is not general average sacrifice. Okay. So try to recollect the 7 perils: fire, explosion, vessel, stranded, grounded, sunk or capsized, overturning, derailment, collision with any external object other than water, discharge of cargo at the port of distress, general average sacrifice, and jettison. This is the basic platform on which other two policies are built, B and A. So basically, you should remember these 7 perils. Then only you can come to know what are all the extra perils covered by B and A. So please understand, you have to remember these 7 perils without any choice. You have to read it and you have to remember it by heart. Okay. Apart from these 7 perils, other expenses also covered by regular sea policy. Expenses like general average charges, salvage charges, which are all the expenses payable to the adjusters or surveyors or loss assessors. It is payable. Liability under both to blame clause. Our cargo may not have damaged, but when two ships are colliding, each ship has to make some compensation to the other ship. That's called both to blame collision. In that also, our share we have to pay. Charges reasonable and properly incurred to avert or minimize a loss is also payable. The loss did not have happened, but the loss is threatening. So to avoid certain threatening loss, some expenditure is made. That expenditure is also payable. And when the goods are damaged or at loss, a surveyor has to be appointed, a loss assessor or claim settling agent has to be appointed. All the fees payable to them are called as extra charges. So all these 4 expenses connected with the cargo are payable, but please understand the perils covered by sea policy is only 7. Please understand the perils covered by sea policy is only 7, but remaining are only the expenses which are payable, right? Now come to B. In policy B, as I told you, C is the basic platform. So C covers 7 perils, automatically covered by B also. The 7 perils covered by C is automatically covered by B also. So apart from those 7, 4 additional perils are covered by B. What are those 4 perils? Earthquake, volcanic eruption, lightning. You can remember this as AOG perils, Act of God perils. Earthquake, volcanic eruption, and lightning. Washing overboard. Board means top deck of the ship. Washing overboard means the water damage done to the cargo by the seawater. Next one, entry of sea, lake, or river water into the vessel or places of storage. Please remember these 3 waters because in add-on covers, 2 more waters are coming. So you can remember this sea, lake, or river water just by remembering these are the waters on which the ship is sailing. Sea water, river water, or lake water. Either into the vessel or into the place of storage. Suppose the goods are unloaded and which are placed on the port's premises, then the seawater damage or some seawater damage is happening, it is also payable. So the water need not enter the vessel, it can enter the place of storage also. Total loss of package lost overboard or dropped. In other words, this peril is called as sling loss. Sling loss means the loss or damages happening during the loading and unloading process. Sling losses are the losses happening during the loading and unloading process. Please note down sling loss, the term sling loss. Right. So policy B covers the sling loss, but only to certain extent. Total loss of package. During a loading process, one packet is dropped, right, on the board of the ship, and it is sustaining some partial losses. That loss is not payable by policy B because it clearly says total loss. When the packet is totally lost, either it is totally lost when it is dropped on the board of the ship or dropped into the sea, right? Lost overboard means it is dropped on the board, that is deck of the ship, and it is damaged. Dropped means it is dropped into the sea, right? Okay. So here 4 additional perils are covered over and above the 7 perils covered under C. So total 11. 11 perils are covered under policy B, ICC B. Try to remember or recollect the 4 perils, extra perils. Number 1, AOG. AOG means earthquake, volcanic eruption, and lightning. And 2 overboard, washing overboard and dropped overboard. You can remember like that. Washing overboard or dropped overboard. And number 3, 3 waters. Number 3, 3 waters. Sea, lake, river water. Okay. So additional 4 perils can be remembered. AOG, 2 overboards, and 3 waters. Okay. So there are total 11 perils under ICC B. Okay. So under B or C, we can add some add-on covers by paying additional premium. The 7 perils and 11 perils under C and B are standard coverage, standard covers, standard policies. Over and above, you can add some add-on covers by paying additional premium. What are the add-on covers? TPND. Please note down the abbreviation. In marine, many questions are asked on abbreviation. TPND, theft, pilferage, and non-delivery. So you should understand what is exactly covered by this class. Theft, you can understand. What is theft? Actually, it is not burglary. Burglary means the removal of the property by force. Theft means removal of the property which is not known to anybody else. So theft is covered. Pilferage means small theft. Out of 100 bags, when 20 bags are stolen, it is theft. But 100 bags remains, but from each bag, some 100 grams are taken, it is pilferage. Then non-delivery. Due to the complexity of the sea transits, sometimes the goods are not delivered or partially delivered. No one knows the reason. Where it has gone, nobody knows. So when goods are not delivered, we don't know the peril acted. So mere non-delivery is not there in any of the 11 covered perils. So if you want the cover against non-delivery also, you have to take this add-on cover. So number one in the add-on covers is TPND, theft, pilferage and non-delivery. Number 2, fresh water and rainwater. We have already seen 3 waters in the basic coverage. Sea, lake or river water. Here there are 2 waters, fresh water and rainwater. Rainwater, no problem, we understand. What is fresh water? Fresh water is nothing but stored water. Stored water either in the tanks of the ship or tanks of the port. Fresh water means stored water. Fresh water may be used to extinguish a fire, so the goods may get water damage. That's also covered by this add-on cover. Number 3, hook or oil. Okay, hook damages and oil damages. Heating and sweating. When the goods are damaged because of the heat of the engine, it is covered. Sweating means by mere accumulation of the water vapor inside the bags. That is sweating. Damage by mud acid. Breakage, leakage, bursting and tearing of the bags. Then comes malicious damage. What do you understand by malicious damage? In motor also we have discussed malicious damage is nothing but the damage done intentionally by third parties. Damage done intentionally by third parties, not by the insured. Okay. So there are 8 add-on covers which can be covered by additional premium with B or C. You have to remember these also, right? TPND. Then all other covers are in pairs. You can remember in pair. Fresh water, rainwater, hook, oil, heating, sweating, mud, acid, breakage, leakage, bursting, tearing, right? Then malicious damage. Malicious damage is automatic cover in ICCA. So there is no need for malicious damage cover in A. But when B and C, you have to cover separately by add-on premium. So these 8 covers are available for add-on covers in B and C, right? Now come to A. A is all risk cover, nothing but all risk cover. What do you understand by all risk cover? All general insurance policies can be broadly classified into 2 types. One is all risk cover, all risk policies. Another one is specified risk policies. Motor policy, fire policy, and all specified risk policies, where the risks are specified. For example, in motor, OD, 10 perils are there. In fire, 13 perils or 14 perils are there. So the perils or risks are specified. In all risk policy, the risks are not specified. Any loss or damage is covered, subject to exclusions. Any loss or damage of accidental nature is automatically covered, subject to exclusions, right? So in standard specified risk policies like fire or motor, it is the duty of the insured to prove 2 things to get a claim. Number 1, the cause of loss is there in the coverage and the cause of loss is not there in the exclusions. Only if the insured proves these two things, he can get a claim under a specified risk policy. This is called burden of proof or onus of proof. Onus of proof or burden of proof is lying with the insured in case of specified risk policies. Now come to all risk policy. The insured can claim anything because there are no risks specified. Whatever may be the loss, the insured will claim. So, if the insurance company wants to reject the claim, then it is the duty of the insurance company to prove that the cause of loss is lying in the exclusions given in the policy. So, in all risk policy, the onus of proof or burden of proof is shifted to the insurance company. In specified risk policies, it is with the insured. In all risk policy, it is shifted to the insurance company. Right. So, in our marine policies, ICCC and ICCB are specified risk policies. Only specified risks are covered, whereas ICCA is all risk policy. So, everything is covered. The insured can claim anything. If the insurance company wants to deny a claim, then he has to prove that the cause of loss is there in the exclusions. Right. So, in all risk policy A, everything is covered subject to exclusions. Having said that, we will see what are the exclusions. There are 9 exclusions. These 9 exclusions are common for all the 3 CBA. Only coverage is different, exclusions are same. Right? We will see one by one. Loss by willful misconduct of the insured. It is nowhere covered in any of the policies. If the insured himself intentionally damaging the property, we will not pay. Number 2, ordinary leakage, loss in weight or volume, wear and tear. These losses are called as trade losses or another term, trade ullage. Ullage means loss. Trade ullage means trade losses. Trade losses means the small losses which are necessarily associated with any trade. That is called trade losses, which cannot be payable by the insurance policy. Ordinary leakage. When you take liquid cargo, 1% to 2% will be lost by leakage. Loss in weight. No peril has acted, nothing has happened, but the weight has reduced. Such losses cannot be paid. For example, take onions. When it was loaded, it was 100 tons. When it reaches the destination, it reached 95 tons only. What happened? The water vapor has gone, right? So, no peril has acted, so we will not pay the claim. Then loss in volume. Take the case of petrol. It is get evaporated over a period, right? So, the volume will be less. We cannot pay. And the regular wear and tear in case of machinery and any other equipment, we will not pay. These losses are called as trade losses or trade ullage. Number 3, loss by inherent vice or nature of goods. No peril has acted, but the loss happened because of the character of the good, a character of the property. For example, all vegetables and fruits have its own shelf life. It will start decaying after that. Each fruit has its own shelf life. Take the case of milk. If you store milk in normal room temperature, it will be useful only for another 8 hours or maximum 10 hours. After that, it start getting spoiled. So this is only because of the nature of goods. That is called inherent vice. No peril has acted, but loss happened. So this cannot be paid. Number 4, loss by delay, even though delay caused by insured risk. Can you understand what is actual meaning of this? Loss by delay, even though the delay caused by the insured peril. I will give you an example. I am taking a milk in a tanker over a period of 50 kilometers. Hoping that I will reach the destination by 1 or 2 hours, I am taking the milk in unrefrigerated tanker. During the transit, the tanker lorry collide with some other vehicle and the milk gets spilled on the road. Claim is payable, very much payable, because collision is covered by our policy. Here collision is the cause of loss. Second chance, because of collision, the tanker is not able to move, but nothing has happened to milk. It is intact, but it is not able to move. So because of delay, the milk gets spoiled. Whether we have to pay the claim? If you follow the principle of proximate cause strictly, it has to be paid, but for this exclusion. If the exclusion is not there, you have to pay the claim, because what the principle of proximate cause says, there is a original cause of loss followed by a chain of events uninterrupted by a new cause. The original cause of loss is collision. Because of collision only, the vehicle is not able to move. Because of the delay only, the milk gets spoiled. So proximate cause is collision. Collision is covered by policy. So we have to pay the claim. To avoid such losses in marine, which are frequent, we are putting this exclusion. Imagine if this exclusion is not there, we have to pay such claims also. The claims where the goods are damaged or spoiled because of delay. So that is why it clearly states the delay due to delay, the damages due to delay is not covered, even though the delay is caused by an insured peril. In the given example, the insured peril is collision. The delay is caused by insured peril only. Even then, we will not pay the claim. So be clear on that. Okay. Next, deliberate damage, malicious damage. So malicious damage, intentional damage done by third parties. I told you it is automatically covered in A. So out of 9 exclusions for policy A, only 8, and policy B and C, there will be 9 exclusions, including malicious damage. So if the policy B and C wants to cover malicious damage, they have to pay extra premium. In A, it is automatic cover. So in the under exclusions under A, malicious damage will not be there. Next one, insolvency of the vessel owner. When the vessel owner becomes insolvent, the creditors will come and take the ship and goods. So that risk we are not taking, we will not pay the claim. Damage due to inadequate packing. Earlier to 2009 classes, only this much was there in the exclusions. If the damages are happening just because of the inadequacy of the packing, then no claim is payable. But nowadays, the packing and logistics are handed over to some other third parties. The insured is not doing it. So we cannot penalize the insured if the packing is inadequate. Right? So the class is modified in 2009 as damage due to inadequate packing is an exclusion if packing is done by insured and his employees. When the packing is done by third parties other than the insured or his employees, then we cannot use this exclusion to deny a claim. Right. Next, war perils. Then SRCC, strike, rate, and civil commotion. So there are 9 exclusions. You have to remember right? Out of which 3 exclusions can be covered by paying additional premium. War, SRCC, malicious damage. So out of 9, 3 can be covered by paying additional premium. For A, malicious damage is automatic, no need to pay extra premium. So 3 perils can be covered, right? So remaining 6 are necessarily exclusions only. You cannot cover these 6 by paying any amount of additional premium. Okay. How to remember these 6? There are 3 exclusions starting with in. Inherent vice, insolvency, inadequate packing. You remember only one word that can be extended. So inherent vice, insolvency, inadequate packing. So out of 6, 3 you can remember very easily. Then willful misconduct of the insured, trade losses, delay. This also you can remember very easily. Willful misconduct of the insured by any policy cannot be covered. Trade losses and delay. So inherent vice, inadequacy of packing, insolvency of the vessel owner, intentional damage by third party insured, trade losses and delay. So these are the 6 exclusions which you cannot cover by paying any additional premium. So by heart you have to remember 7 perils are there in ICCC, 11 perils are there in ICCB, 8 add-on perils which are called as extraneous perils. Other name given to these 8 add-on perils are called as extraneous perils. These extraneous perils can be covered by paying additional premium. Then A is all risk policy, covers everything but for exclusions. What are the exclusions? 9 exclusions. 3 can be covered by additional premium. Remaining 6 you have to know by heart. Okay. So we'll break for tea. Now it is 11:37. We will assemble by 11:50. Thank you. Friends, okay, let us start again. Can you hear me?
Yes, sir.
Okay. So we have seen coverages available for import or export, that is sea voyage, CBA, and what are the coverage, what are the exclusions, what are the add-on covers. Okay. Unseaworthiness, what is the change in 2009 classes? We have already discussed. To for the purpose of rotation, I am again saying unseaworthiness of the vessel, if it is known to the insured, then we can claim that warranty. We can reject a claim if the ship is unseaworthy. If the unseaworthiness is not known to the insured, then there is no chance for us to reject a claim. Okay. Now come to duration. Actually, in all general insurance policies, the duration of the policy period is 1 year or 12 months. Those policies called as time policies. Time policies means from one particular date, time to another particular date and time. But marine policies, remember, we are discussing a specific voyage policy, and all other policies we will come to in a later stage. We are now discussing a specific voyage policy only. Okay. So, specific voyage policy means for a single transit from one place to other place, irrespective of the time taken. It may take a few hours to few months. But our policy is continuing till the goods are reaching the specified destination. Right. So having said that, we cannot leave it in a unspecified manner. We have to specifically declare when the policy commences, when the policy ends. Okay. So we will see first when the policy starts. Prior to 2009, the ICC classes said when our policy starts, our cover commences when the time the goods leaving the warehouse named in the policy. So our cover starts when the goods are leaving the warehouse. So once the goods are coming out of the warehouse compound, then only our cover starts. This naturally raised a question. Then loading is covered or not? So prior to 2009, loading is not covered, because after loading only the lorry can come out of the compound. So when it is come out of the compound only our cover starts. So loading was not covered prior to 2009. So 2009 class, which is we are using now, it clearly states that from the time the goods are moved inside the warehouse for the purpose of transit. So our cover starts from the time the goods are moved inside the warehouse for the purpose of transit. Suppose there is movement of goods, there may be movement of goods within the warehouse from one point to other point within the warehouse. It is not meant for transit. When the goods are meant for transit, it is moved. Then our cover starts. That clearly says loading is automatically covered. Loading is automatically covered. As of now, loading is automatically covered. So the point of cover starts from the time the goods are moved inside the compound for the purpose of transit. Okay. So it continues, our cover continues in the ordinary course of transit, whatever it may be, lorry, train, or sea, then again to lorry, whatever it may be the normal course of transit, our cover continues. The cover ends, our cover is terminated when? One, on delivery at destination. When the goods are delivered at the destination given in the policy, our cover ends. Again, you see the wording delivery. So whether unloading is covered or not, it has to be covered, because without unloading, you cannot deliver it to the buyer. So after unloading only you can hand over. So when the handing over is over, then only our cover ends. So unloading is automatically covered. So from 2009 classes, loading and unloading automatically covered. Okay, now come when the cover ends. Point number 1, when it is delivered to the destination. Number 2, on delivery at any intermediate point belonging to the insured. This is one important point. You should understand why. When the goods are in the carrier's custody, our cover continues. But when the goods are delivered to the insured custody, our cover ends. It may be a destination, may not be the destination, may be any intermediate point. I'll give you an example. The goods are booked as per invoice from Chennai to Coimbatore. Our policy issued is also states the coverage is from Chennai to Coimbatore. But during the transit, if the insured wants the goods to be unloaded in his own place at E-Road, whenever the goods are unloaded and given to the insured custody, our policy ends. When the goods are going into the custody of the insured, our policy ends wherever the place may be. This is the second point. Third point, after 60 days from the date of discharge at the final port. Suppose the goods are coming from abroad to Coimbatore. The final port may be Chennai or Kochi or Thoothukudi. So whenever the goods are delivered at the final port, the inland transit from Chennai to Coimbatore should be completed within 60 days after unloading at the port. A question may arise. Why, sir? Why it is so? We have given the policy from London to Coimbatore, and you told us that time is not material. It is unspecified time. So till the goods are reaching Coimbatore, we should give a cover. But there are some other reasons. You know, the prices of goods are fluctuating. Whenever there is a upmarket, the insured will bring the goods at the faster phase and he will try to sell the goods. When the goods are in down market, downtrend, if he brings the goods from Chennai to Coimbatore, he may not sell them immediately. So he has to rent a warehouse, give rent, take a fire policy, take a burglary policy, put a watchman, everything he has to incur. But if he leaves the goods at Chennai port itself or in the warehouse in Chennai itself, our cover continues. So all the insurance needs are taken care by the marine policy. So insured may be tempted to do that. So to avoid that, we are fixing a time limit, 60 days from the discharge at the final port. Sometimes this is the standard cover. Sometimes the insured may be wanting some to extend. Suppose goods from Chennai, it has to reach Jammu and Kashmir. It may take more than 60 days. So we can give an extended cover. There is a strike at the port. The goods cannot be taken out. We can extend the 60 days cover, but only on request from the insured and agreed by the insurer and getting an additional premium. Right? So there are 3 chances for termination of the policy. One is on delivery at destination, or delivery at any intermediate point belonging to the insured, or after completion of 60 days from the discharge at the final port. But it can be extended if there is a request and agreed by the insurer. Suppose the goods are transshipped to some other destination which is different from the destination given in the policy, then our cover immediately ceases on commencement of the such different forward journey. The goods are delivered at Chennai. Original destination is Coimbatore. Instead of coming to Coimbatore, it is moving towards Hyderabad. Then our cover ends. So once the journey towards Hyderabad starts, our cover ends, right? Again, this can also be modified by request of the insured, by agreement with the insurer and paying additional premium, right? Okay. Then war risk. War risk, we have two slides, detailed slides. But one thing you should remember, always war risk is covered only on water. This is given in waterborne agreement. Waterborne agreement is a clause mentioned in all the policies which states that the war risk covers the goods only when the goods are waterborne, that is on water. Once the goods are brought to land, war cover ceases. Okay, this is the limitation of the war cover. Okay, so this is the duration of cover. You should remember when our cover starts, when our cover ends. Okay, we have already discussed, if it is forward to summer destination, our cover ceases. Change of voyage. Change of voyage, we have already discussed. Suppose the voyage is changed, it should be intimated to the insurance company and get coverage. Otherwise, our cover ceases. Okay. So we have seen ICC coverages covered. What is the coverage? What are the exclusions? What is the duration of cover? Everything we have covered. Now come to air. When the goods are coming through air, right? Same as ICCA. There is no separate policy for air, separate terms and conditions for air. You can use ICCA itself, ICCA itself. B and C covers are not given for air cargo. Only A cover is given. Duration, there it is 60 days from the date of discharge. Here it is 30 days. Here it is 30 days. As usual, war and SRCs can be covered by additional premium, right? General average and salvage charges not covered. Why? Because in air, there is no possibility for general average sacrifice. Coming slides. So both are not there in the air classes. So air classes, only two changes. One is instead of 60 days, it is 30 days. And general average sacrifice class and salvage charges class are not there in the coverage. War cover terminates 15 days from the midnight of the day of arrival at destination airport. For sea voyage, war cover is having some more classes that we will see. As far as air cargo is concerned, the war cover is terminates 15 days from the midnight of the day of arrival on destination airport. You should understand the logic, then you can remember this. Why general average sacrifice cover is removed from air? It is not possible in air, right? The same way in sea voyage, we say war cover is only when the goods are waterborne, that is on water. That condition cannot be imposed for air. The aircraft cannot remain in air forever. So it has to land at some point of time. So we are giving cover after landing at the airport. 15 days cover will be there for war risk. Registered parcel sending. Registered parcel sending, there is no specific classes. You can use either ICC class or ITC, inland transit classes, as per the requirement. Our cover starts with the registered receipt of the parcel and ends only when the goods are delivered. Very simple, right? No claim for loss of contents with seals of the packet intact. When the packet itself is not damaged, but the goods inside are damaged, means it is inadequacy of packing, so it cannot be covered. So when the goods are damaged, when the packet is intact, we cannot pay the claim. And the insured may be having insurance with the postal authorities also. So we will pay only the balance amount. The insured has to take insurance with the postal authorities, and the uncovered amount only will be covered by our policy. Okay. Now come to inland transit. ITC, inland transit within India. Again, there are three classes, CBA. After this 2009 modifications, ITC-C is removed. We are not at all using ITC-C nowadays. So forget about that. There is no cover called as ITC-C. Okay. Now come to ITC-B. Physical loss or damage by fire, lightning, breakage of bridges, collision or overturning, derailment. That's all. So 1, 2, 3, 4, 5. Only 5 perils. Fire, lightning. Okay. Then remaining 3 are road risk, breakage of bridges, collision or overturning, derailment. Only these 5 risks are covered by ITC-B. Nothing else. As usual, 8 external perils can be covered by additional premium. A is, as usual, all risk cover, exclusions as per ICC classes. These 9 exclusions are there. Only one change. In ICC, we can cover VAR and SRCC by paying additional premium. Here, you cannot cover VAR. You can cover only SRCC by paying additional premium. VAR cover cannot be extended for domestic transits. Duration. The same way, the commencement is as per ICC only. The expiry only after 7 days. There after 60 days from the reaching of the final port. Here, 7 days of arrival of the vehicle at the destination town. So whenever the vehicle reaches the destination town, it starts from the midnight of that day. The cover continues for 7 days or till the goods are delivered. Okay. In case of road transports are subject to a warranty which says whenever there is no recovery rights, we will pay only 75%. First of all, you should understand what are recovery rights. I am transporting my household goods, right, from Coimbatore to Chennai in a lorry. Forget about insurance. I don't have insurance, right? I don't have insurance. I am entering into an agreement with the lorry owner for transport my goods in a safe condition. During the transit, due to negligence of the lorry driver, accident happens, my goods are damaged. So by common law, I have a recovery right to get a compensation from the lorry owner. That's called recovery right, right of recovery. Okay. Now come to insurance. I have an insurance. So without insurance, I have to sue the lorry owner and the driver, then get the compensation if there is no insurance. Suppose I have insurance. So I claim the losses from the insurance company. But still, the recovery right exists between me and the lorry owner only. Because me only having the contact with the lorry owner, insurance company don't have any contact with the lorry owner. So insurance company cannot have recovery rights against the lorry owner. So I am only having the recovery rights. Suppose I am getting the compensation from insurance company and again suing against the lorry owner, getting some more compensation. It is more than my loss. So indemnity principle is defeated. So what indemnity principle says? Nobody should get a profit out of an unfortunate event, right? So I should not get the profit. So what I should say, what I should do? I should transfer the recovery rights to the insurance company on getting a claim. So I cannot claim against insurance policy and against lorry owner simultaneously. So I have to surrender my recovery rights to the insurance company. or in other words, I have to transfer my recovery rights to the insurance company. Then insurance company, based on the rights, that process is called subrogation. The process is called subrogation. Subrogation is the process of transferring the recovery rights to the insurer. And the insurance company, after getting the recovery rights, after settling the claim, may proceed against the lorry owner and whatever possible recovery he can make. Right? So these are called as subrogation rights. You should understand the subrogation rights, there are 3 rules. Subrogation rights are surrendered to the insurance company even before the payment of loss. Because if the payment is already made, the insured will not come forward to surrender the rights. So even before the payment of claim, the insured is transferred the recovery rights to the insurance company. Number 2, the insurance company, even though they are possessing the recovery rights which are transferred from the insured person, they cannot execute the recovery rights till the claim is paid. They have received the recovery rights, but they cannot use or they cannot execute the recovery rights till a claim is made. Claim is paid. Number 3, the subrogation rights are limited to the amount paid. I'll give an example. The insured sustained a loss of 1 lakh rupees. The insurance company has paid only 80,000, deducting some excess and something. The recovery rights are transferred and the insurance company is proceeding against the lorry owner and getting the 1 lakh back as recovery. Since the insurance company has paid only 80,000 to the insured, it cannot retain 1 lakh. So it has to pay the remaining 20,000 to the insured. That means, in other words, subrogation rights are limited to the amount paid. The insurance company can retain the amount recovered only up to the claim paid. So subrogation rights, 3 rules. Subrogation rights are transferred even before claim payment, but the insurance company cannot execute them till the payment is made. Number 3, the payment received is subject to the amount paid. They cannot retain more than that. Okay. So these are recovery rights. Whenever there are no recovery rights, the insurance company will pay only 75%. Yes, non-standard, we don't have recovery rights. Okay. How you know there are no recovery rights? In many cases, the contract or way bill between the insured and the carrier, some words are printed like carried on insured's own risk. That means the insured's own risk is the carrier is no way liable for the damages happening to the goods. In that case, there are no recovery rights. Right? Suppose the insured is carrying the goods in his own lorry. Then also there are no recovery rights. We will pay only 70%. The goods are carried in couriers. If you see the courier bill, the reverse of the courier bill, if you go through that, the small letters printed so many conditions. One of the condition is the courier company's liability for damage of goods is limited to 100 rupees per packet. Whatever you send through the packet, their liability is only 100 rupees. In this case also, we don't have recovery rights. So we will restrict to 75% of the claim amount. Okay, inland classes, yes, I told you, ITCC is removed, only B and C are now there. Packing exclusion, just like ICC. Transient commencement, yes, in ICC, changed. Everything we have already discussed. Seaworthiness is, the word seaworthiness is changed as roadworthiness. If the roadworthiness is not known to the unroadworthiness is not known to the insured, we have to pay. If it is known to the insured, we can reject the claim. Just like ICC, based on ICC changes, ITC also changed. One additional change, ITCC is removed. Okay. Whenever some particular commodity is on transit, we will use commodity classes. Commodity classes will overtake the ICC classes. Some changes will be there. We will see what are they. In regular policies, ICC A, B, C, the limitation is 60 days from the date of discharge at the final port. Air cargo 30 days. Inland transit 7 days. War classes C 15. That is only when the goods are waterborne. War classes air, actually it should be 15 days. You correct the slide. 15 days on discharge. Strike classes C 60 days, air 30 days. SRCC within domestic travels, it is SRCC is 7 days. Okay. Now come to commodity classes. Commodity trade, you can use 60 days. Normal commodities 60 days. Coal classes. Coal classes again 60 days covered, but only one major change in coal classes is the spontaneous combustion is covered. If you attach the coal classes, spontaneous combustion is covered. What is spontaneous combustion? When the coal is stored in a heap, because of the heat generated at the bottom of the heap, it will get fire, right? So it is spontaneous combustion. It is actually inherent vice. It is nature of the coal. So we can deny a claim if spontaneous combustion happens without coal classes. But if coal classes are attached, the spontaneous combustion is automatically covered. So that means inherent vice is covered under coal classes. For jute, it is only 30 days. Natural rubber, it's 30 days. Timber, 60 days. Bulk oil, 30 days. Frozen food, only 5 days. Okay. We'll come to discuss about the war cover. We have already seen war cover is covered only when the goods are waterborne. But again, there are some other points which you should remember. War cover attaches only when the goods are loaded in the overseas vessel, that is on waterborne. After arrival, if unloading is delayed, war cover is limited to 15 days from the midnight of the arrival. The ship is arrived at the port. It is still waterborne. So our war cover should continue normally. But this clause says, for due to some reason, unloading is not happening. So 15 days are over from the date of arrival. Then war cover is suspended. Please understand, war cover is not cancelled. War cover is only suspended. That means it can recommence. At what stage we will see. So first understand, even though goods are waterborne, after reaching of the port, the goods are not unloaded for 15 days. The war cover is suspended after 15 days. Number one. Next one, if transshipped by another vessel, war cover reattaches when the goods are loaded into other vessel. For some reason, this ship is not going to the destination. Some other ship is going. So these goods are loaded into some other ship. So our war cover reattaches. That's why I use the word suspended, not cancelled. So our war cover again attaches when the goods are loaded into the other vessel. It need not start. Once the goods are loaded onto the other vessel, our war cover starts because it is already waterborne. When full cover does not apply, after 15 days we say war cover is suspended. But the insured may ask, sir, full cover I don't want, but I want minimum cover for torpedoes. Derelict torpedoes means underwater abandoned missiles. Even though the ship is not moving, normally missiles are used to destroy the ships during war. Unexploded, unused missiles may be there in the seabed. Because of that, some damage may happen to the ship. So this restricted cover, which may be expected because of the abandoned missiles, can be given, that too only for 60 days. So regular war cover is not given after 15 days, but the abandoned missiles cover can be given, that too only for 60 days. Right. When relaxation of the waterborne clause is allowed whilst the goods are being transshipped at an intermediate port, but this is subject to restrictions both in location and time, as already explained. The particular port is not the destination. It is a transshipment port. It is unloaded onto the port and it has to be loaded to some other ship, right? And it will be going towards destination. So there is a relaxation for the waterborne agreement. So this time the goods are not on water, it is on land. Even though it is for the purpose of transshipment, the war cover continues. That is the one exception given. Terrorism cover forms part of SRCC class, not of war class. Once they have asked this question, we are not getting any extra premium for terrorism. Yes, we are doing in other policies, in marine. In marine, we are not getting any extra premium for terrorism, right? In fire and all, SRCC, we are getting separate premium, and terrorism, we are getting separate premium, right? But here, the terrorism is automatic cover under SRCC, not under war. If a person has taken only war cover, then terrorism is not there. If a person has taken war and SRCC, then terrorism is automatically covered under SRCC. Okay, we have already discussed no proposal form, only a declaration giving the details will be enough. Premium rate, how we are rating the transit. Nature of commodity, very important role in fixing the premium. Fragile items are higher rated and other items like timber and all is lower rated. Method of packing, if the method of packing is good, it will attract lesser premium. The vessel, if the vessel ship is good, strong enough, we can give lesser premium. Type of insurance cover, A, B or C. Age of the vessel. Age of the vessel plays an important role. Up to certain age of the vessel only we give standard premium. And if the age is more, we will charge more. That is called overage loading. That we will see in the next slides. Overage loading. Overage means if it is more than certain age, we will load the premium. GRT, registered gross tonnage. If the tonnage is less, then we will charge more. If the tonnage is more, we will charge less. It is just the reverse of the case of the motor vehicles. In motor vehicles, if the GVW is more, higher premium. GVW is less, lesser premium. It is just ulta in the case of ships. If registered tonnage is more, lesser premium. Registered tonnage is less, it is higher premium. Why? In all cases, I am telling you, if you understand the logic, you will not forget the class. Because the lesser tonnage means the base of the ship is less. The base of the ship is very less. So it is bound to capsize. So the smaller ships are having higher risk of capsize. So we are charging more on that. The bigger ships, the stability is more. The stability is high. So the chances of capsizing, sinking are less. So we are charging lesser rate for bigger ships and we are charging higher rate for smaller ships. Deck cargo, we are charging higher rates for deck cargo. Deck cargo means which are carried on the top deck of the ship. Because as per Carriage of Goods by Sea Act 1925, we don't have recovery rights for the goods carried on the deck. Because of that condition, we are charging more. Flag of convenience, just like motor vehicles have to be registered, all the ships have to be registered with the authorities. But certain countries having very less stringent conditions, you can get the registered even for the inferior ships. Some African countries are there. So the flag of convenience means the registration details. Based on the registration details, we have to charge more. Chartered vessels, the entire vessel is taken by a single insured, we can charge less because he will take more care. Packing, we have already seen. Okay. Now comes to loadings. As I told you, smaller ships are loaded with the loading. We call it as under tonnage loading. So if the GRT is less than 1,500 tons, we charge more. If the ship's carrying capacity more than 1,500, then we are charges less or standard premium. Then overage. Overage loading, it is different ages are prescribed for different types of ships, right? For tankers, bulk carriers, it is 10 years. Other vessels, 15 years. Liners, 25 years. Container vessels, 30 years. We will see what is liners in the hull class. Okay. Non-approval of the vessel. If the vessel is approved by the Registry of Shipping in India, lesser premium. It is non-approved, more premium. Null classification. Again, the vessel is not classified, then we will charge more premium. Okay. So till now, we have seen the standard terms and conditions. In certain areas, we will use some extra clauses to safeguard our interest as well as to safeguard the insured's interest. We will see one by one what are all the clauses used in the marine policies. Comprehensive clause to include the extraneous risk. What are the extraneous risks? We have seen 8 extra perils covered by ICCC and B. Whenever you are covering those 8 perils, any of the 8 perils, you have to use the comprehensive clause, right? Next one, institute replacement clause for new machines to allow insurer only to replace the damaged parts. Replacement clause says the insurance company is liable to replace only the damaged parts. The insured cannot claim that because of the damage to a critical part, the entire machine went out of use, so you have to give total loss. The insured cannot claim like that. We are liable only to replace the damaged parts only. Second-hand replacement clause. This is very, very, very important. Please listen carefully. Whenever the second-hand machinery is on transit, there are certain rules to be followed. For new machinery, absolutely there is no problem. There is an invoice and we can insure it for 110% of the invoice value. Whenever parts are damaged, we will replace the part. Total loss happens, we will give the total loss. Absolutely no problem. Whenever the second-hand machinery is on transit, suppose a 10 years old machinery, I have bought it for 1 crore, right? But if I buy the same model machinery, brand new machinery today, it will cost 5 crores, right? Normally what we are doing, the insured says, I have bought it for 1 crore, so I am taking insurance for 1 crore. Right, we have given the policy. Suppose the machinery is damaged, one major part is broken, that small part itself may cost for replacement more than 1 crore. At the time, it will become a total loss, right? So we don't have adequate insurance. So for second-hand machinery, please you can note down also, which will be useful whenever you are undertaking second-hand machinery in the office. Condition number 1. The second-hand machinery should be insured only for replacement value, not for the purchase value. In the given example, replacement value is for 5 crores, purchase value is 1 crore. So you should insure it only for 5 crores, not 1 crore. Even though the insured has bought the machinery for 1 crore, he should insure it for 5 crores. That is the replacement cost. Okay. Number 2, wherever necessary, you should insist on pre-insurance survey. The dismantled machinery should be inspected by a surveyor and the safety of the machinery should be certified. Without the pre-insurance survey, you don't insure the second-hand machinery because it might have already broken. Number 3, whenever the partial losses happen, it is paid without depreciation. Even though it is old machinery, we are paying without depreciation if partial losses happen. If a total loss happens, we have to pay only the market rate or purchase rate. Why, sir? Our sum insured is 5 crores. He has paid the premium for 5 crores. In case of total loss, if we pay 5 crores, then the insured is getting more than the indemnity because he has bought the machinery for only 1 crore. If he is getting 5 crore from the company means he will intentionally destroy the machinery. So very simple. If you put the second-hand machinery class, which you have to do. So these conditions you remember whenever second-hand machinery is coming for insurance. Number 1, pre-insurance survey. Number 2, should be insured for replacement cost, not for purchase cost. Number 3, whenever there is a partial losses, it is settled without depreciation. Total loss, only market rate is settled, not the replacement cost. Right? So in other terms, when you attach the second-hand machinery class, it makes the marine policy as an MBD policy because all the conditions I have told is the MBD policy conditions. All the classes, all the points, right? So definitely you should attach the second-hand machinery class. Not only you are receiving the premium for replacement value, you should attach the second-hand machinery class. Otherwise, again, it is treated as a normal policy and normal settlement will be applied. So don't forget to attach second-hand machinery class. Okay. Next, parent set class. This is again there in so many policies, in fire policy, all risk policy, all policies are having this class, parent set. Whenever a single unit of the pair or set is damaged, we will replace only that part. We will not replace the entire pair or set. Cutting class. Imagine there is a big glass, only corner of a small portion of the glass is broken. The insured may claim, I cannot use this glass for the purpose for which it was intended. So I will claim total loss. This is the insured position, but we will not pay the total loss. We will say, cut down the damaged portion, sell the remaining portion in the market. We will say the difference only. Difference between the sum insured and the sale proceeds, right? Label class. Again, this is important. What is label class? Imagine liquor bottles, glass bottles, and labels are affixed on the glass bottles or on transit. The bottles got water damage, so labels are gone. The contents inside the bottles are intact. It can be used. But nobody knows what is there inside the bottle without the labels. So the insured may claim total loss because I cannot use it. I cannot sell it in the market. It is meant for human consumption. So I cannot take a risk. Nobody knows what is there inside the bottle, is acid or liquor. Nobody knows. So he can claim a total loss. But what label clause says, nowadays, there are other techniques are followed other than label to notify the contents, quantity, quality, everything by printing a barcode or in small letters on the neck of the bottle, something is printed. If you see those printed information, you can ascertain what is there inside the bottle, quality, quantity, everything. If such information is available, then our company's liability is limited to the cost of printing and affixing the labels, because you know the contents. So from the barcode you have printed on the bottle, get the information, print the labels and affix it, you can sell in the market. So our liability is limited to the printing and affixing the labels. Suppose that facility is not there in these bottles, barcode is not printed on the neck of the bottle, then there is no choice. The claim will be treated as a total loss. The insured will be paid total loss, but necessarily the entire content should be destroyed. This is important condition. Whenever you are paying total loss, the salvage belongs to the insurance company. Without knowing the quality of the contents, you cannot sell it in the market. So necessarily it should be destroyed. Right? So this is the label clause. Whenever the barcode is there, you have to limit your liability to the printing and affixing of the label. If it is not there, settle total loss, destroy the contents, entire goods. Nowadays, a different version of the label clause is used by many companies. That clause says, if the labels alone are damaged, no claim is payable, whatever may it be. Labels alone are damaged, not the contents, then nothing is payable. That is the latest label clause which are used by many companies. Please understand, these classes are not standardized. Each company can use their own classes. Next one, brand and trademark. The same way as label. Take the case of garments. The garments which are on transit, water damage happened, but it can be still stored in the market, but maybe for a lesser rate. But the insured may claim, sir, that garments is having my brand name and the quality has deteriorated. With inferior quality, if the goods are going to the market, my brand image will get affected. So I will not accept partial loss. I will accept total loss only, because these goods should not go to the market. Again, the same way, if the labels can be removed, brand name can be removed from the garments. Sometimes only a small flap may be attached to the garment with the manufacturer's name. If the flap is removed, then there is no brand in the garment and it can be sold in the market with the inferior quality. Whatever the sale proceeds you are getting, you are reducing it from the sum insured and paying the remaining claim. If the brand name is not removable, for example, brand name is embroidered on the garment, the name cannot be removed. So necessarily you have to settle a total loss, and again this contents, entire goods should be destroyed, because the insured says the inferior quality goods should not go to the market. So you have to necessarily destroy the goods. The brand name can be removed. You remove the brand name, sell in the market, reduce it from the claim. If the brand name cannot be removed, settle for total loss, destroy the goods. That's all. Okay. Next, concealed damage. 45 days delayed opening. When the goods are coming in the containers, if the insured is not opening the container and after 2 months he is opening and informing us the damage, we will not pay. So we are allowing 45 days within which the container should be opened and damages should be found out. Debris removal. Sometimes what happens, the debris removal cost is more than the cost of the goods. In normal policy, debris removal is not covered. We will pay only the sum insured. That's what I told, abandonment. The liability may be the debris removal expenses or liability. It is not taken by the insurance company. So it has to be borne by the insured. So if the debris removal sum insured is specifically mentioned and taken as an add-on cover and additional premium is paid, we can pay for debris removal also. Next one, picking class. Example of cotton. Some foreign material entered. We will pay the cost of removing the foreign material only. We will not take into the total loss. We will pay the cost of removal of foreign material only. Garbling class. Example, tobacco. If some part of tobacco is got damaged by water, that part only is cut down. Remaining part should be used. We will pay only the remaining portion. Insured classification class says it should be carried, goods should be carried only classified vessels, not in the regular vessels. Loading, unloading for railway wagons. The rail class says when the goods are taken in railway wagons, the loading or unloading is not covered because whenever the goods are carried in railway wagons, 95% of the damage happens only during the process of loading or unloading. So our policy normally exclude the such damages. If they want cover, they have to pay additional premium and cover loading and unloading also. When the goods are going in railway wagons, please understand, when going through lorry or ship, everything is covered. Loading and unloading is covered. Only loading and unloading during the rail transit are not covered. Not in your class. This is a standard class. As I told you, the policy can be assigned to any third party without intimation to the insurance company. The insured can assign the policy, the benefit of the policy to anybody. But this class says, please understand, it is not insured, it is not insured, it is inure, not inure class. Okay. It says you can assign the policy benefit to any third party except the carrier. The insured cannot assign the policy to the carrier. If it is assigned to the carrier, then there is a problem. It may lead to fraudulent claims. So it cannot be assigned to the carrier because he is the person who is taking the safety of the goods. So it cannot be assigned to the carrier. Reasonable dispatch class is regular class which compels the insurer to take all the precautions for the safety of the goods, safe transit of the goods. The goods should be packed, goods should be carried in such a manner that it reaches the destination without any damage. Okay. So far, we have discussed what is ICC, ITC, coverage, exclusions, extra classes to be used, everything. So in simple words, we have discussed about the specific voyage policy from one place to other place, right? But specific voyage policy alone cannot meet out the requirements of all the clients. Each client needs a different policy. So there are some other policies also we are using in marine. We will see one by one. First one, open policy. There are two policies which we are getting confused. One, open policy. Number two, open cover. Please understand, open policy is only for domestic transit. For import and export, you cannot use open policy. You have to take open cover only. First, we will see open policy. Number one, it is for domestic transit. Next one, policy period is 1 year. Then the sum insured will be the estimated transits of the insured during that particular year. Right? So insured has declared the sum insured. He has paid the premium. We have issued the policy. Right? Okay. Now the policy commences. Actual transit happens. The insured will give a document called declaration stating the details of the transit. Then we will issue a certificate noting down the details of the transit. Whenever a declaration is given, a certificate is issued, the sum insured got reduced to that extent. Suppose 10 crores is the sum insured, 1 crore is the first dispatch. So the sum insured is reduced to 9 crores after this dispatch. In the same way, every day he will give the declaration, we will give a certificate, the sum insured get reduced. Suppose before exhausting the sum insured, the insured should enhance the sum insured. The policy will cease once the sum insured is exhausted or 12 months is over, whichever is earlier. Even after 12 months, the sum insured is not exhausted, then we can make proportionate refund to the insured. So this is very simple about open policy. What is our advantages? Instead of issuing hundreds of specific voyage policies, we are issuing only one policy, and remaining we are issuing only certificates for each transit. So our work as well as the insured's work is reduced, and automatic cover is given, and insured is saving on the stamp duty part because it has to be paid by him only. Only one policy, one stamp duty. Now come to open cover. In open policy, we are issuing a regular policy with a specific sum insured. So we are affixing a stamp because it is a policy. In open cover, initially we are not issuing any policy. We are just entering into an agreement with the insured stating the following details. What are all the goods to be covered? What are all the interest from which place to which place? And which policies he wants, either A, B or C, and any other specific information needed that will be mentioned in the request, and the insurance company will issue an agreement to the insured. It is only an agreement. What are the things agreed? The goods details agreed, policy agreed, rate agreed, special conditions agreed. This is only an agreement. It is not a policy. So naturally, when there is an agreement, it is no policy because insurance stamp can be affixed only for insurance policies. Since this is not a policy, stamp is not affixed. Okay. So agreement is given. The period has commenced. The insured is declaring. So before going to that, you should understand open policy is for domestic transit, open cover is for export and import. Right. Insured is declaring the first transit. The insurance company can issue a certificate or can issue a specific voyage policy, whichever is convenient to him. Either way, the certificate or specific voyage policy should be affixed by a stamp. Okay. Where is the premium for this specific voyage policy or certificate? In open policy, he has paid the full premium for the given sum insured. Here, there is no sum insured at all. Overall sum insured is not there. So for the specific sum insured of this policy, he should pay the premium. For that purpose, he should keep a deposit with us. Then only we can give the backdated cover to accommodate this declaration. So whenever the insured is giving the declaration, we are either issuing a certificate or a specific voyage policy with a stamp, and the premium is taken from the deposit already paid by the insured. It goes on like this. It goes on for 12 months. Since there is no sum insured, there is no exhaust of sum insured is involved. But the insured should be keeping an eye on the deposit, enhance the deposit whenever required, and we will continue to issue the policies. Right? There is no limit for number of policies issued in the open cover. To understand, both the policies are mutually exclusive. Open policy domestic, this is export and import. That is policy issued, here there is no policy issued. There certificates are issued without stamp, here certificates are issued with stamp. Right? And some more points which are common to both the policies. Number one, limit per bottom or limit per transit, limit per shipment, whatever you call. Why we have to limit? Suppose the insured is saying that my annual transit limit is 100 crores. We assume that it is happening throughout the year in hundreds of transits. So we are issuing the policy with the rate to sustain the given transit. Suppose the insured is sending 90 crores of goods in only one transit and it goes to the total loss, then our assumption failed. The rate charged is very less. So to avoid this situation, we are putting a limit on limit per transit. Limit per transit means it is the insurance company's liability is limited to a certain amount for single transit. Either it may be in a lorry, in a train, in a ship. In a single transit, our liability is reduced. For example, if 100 crores sum insured for a year, you can limit your insurance company can limit our liability either 1 crore or 2 crore. Right? Based on this limitation only, the rate is charged. The underwriting capacity or the underwriting limitation is also applied on limit per transit, not on the total sum insured. Second one, limit per location. When the goods are meant for export, all the goods reaches the particular port in so many lorries. On the platform of the port, all the goods are stored. If something happens on that particular location, everything is gone. So we are limiting our liability for location also. Normally, it is twice the limit per transit. If the limit per transit is given 2 crores, the limit per location can be 4 crores. But it is not fixed based on the requirement, based on the goods, it can be changed. Right. One question I want to ask. We have issued a policy, sum insured 100 crores, limit per transit 2 crores, and in a particular transit, the insured has taken 5 crores in a single ship and the entire thing was lost. Whether under insurance has to be applied on this? No. Because in marine policy, this open policy and open cover, by putting these limits, like limit per transit and limit per location, the insurance company is only limiting its own liability per transit. It is not imposing a condition on the insured, you should not take more than this in a single transit. It is up to the insured to decide. If the insured is taking goods in a particular transit more than the limit per transit, then he is the insurer for the remaining. He will not pay anything for that. but under insurance is not applied. If 2 crores is the limit per transit, 5 crores is taken, entire thing is lost, we will pay 2 crores. That's all. We will not apply under insurance in this case. Limit per location also in the same case. Okay. Base of valuation, cost and freight, see, invoice cost plus 10%. Okay. Then, declaration class, this is very, very much important in case of open policy as well as open cover. The insured is giving a declaration stating that all my transits will be declared for insurance without fail. Why we are imposing this condition? Normally, the declarations either in open policy or open cover will be given in the next working day after the transit. If the transit is happening on Friday, the declaration has to reach our office on Monday. Suppose the goods reached the destination by Saturday or Sunday safely, the insured may not declare it to us on Monday. He will skip it. By doing that, he can save the premium. It should not be allowed because we are giving automatic cover. Something happens to the goods also, we are paying, even if it is not declared to us till the loss, we are paying it. So automatic cover is provided. So all the declarations, all the transits should be declared without fail. Okay. How we will find out whether all the transits are declared or not? In normal course, we will not bother about that. Whenever the claim is reported, we will take the accounts books of the client, compare it with the declarations we have issued, and if there is anything missing, we will not pay the claim. Even though the loss happened in the declared invoice, but he has not declared some 10 invoices earlier, which were not, where loss has not happened. But the loss happened in the declared invoice, but 10 invoices not declared to us, so we will not pay the claim. But if the insurance company thinks that the non-declaration is genuine, out of 1,000 declarations, he missed 1 or 2. It is genuine. We may waive that and pay the claim. If the non-declaration is intentional, then we will not pay the claim. So declaration clause is very important. Cancellation clause, as usual. Terms of cancellation, 7 days notice, everything is like the other policies. Certificates, endorsements, as usual. So this is the tabulation. I have tabulated for open policy and open cover. Open policy for inland transit, open cover for export import, open policy stamped document, unstamped document. Why we are stamping it? To make it legally enforceable, right? So open policy is legally enforceable even in the initial stage, but open cover, unless it is followed by a stamped certificate or stamped policy, it is not legally enforceable. Open policy, it is a fixed sum insured. In open cover, there is no sum insured at all. So each declaration will have its own sum insured. Sum insured get reduced. So here sum insured is not get reduced because there is no sum insured at all. Sum insured get exhausted. Either you have to enhance the sum insured or you have to take a new policy. In open cover, the policy ends only after 12 months. Certificates are not stamped because policy itself is stamped. Here, certificates are stamped. Okay. So we have seen open policy and open cover. We will see these are the 2 important policies which you may get many questions, but there are certain other policies also. Please listen carefully because many questions are asked with the types of policies and their some special nature only. Special declaration policy. Special declaration policy is just like open policy with a very few changes. When I'm telling you just like open policy, please understand it is again only for domestic transit, right? These policies we never use in our office regularly because this is obsolete. There is no requirement of these policies nowadays. But from examination point of view, you should know all this. Right? So special declaration policy, what are all the changes from open policy? Number one, minimum sum insured is 2 crores. Minimum premium is 5,000 rupees. Right? In open policy, declarations are to be made on the next working day. In special declaration policy, declarations are made at agreed interval of time. It may be weekly, maybe monthly, like that, maybe a fortnight, like that. So it should be agreed between the insurer and insured when the policy is issued. These are the three major changes between open policy and special declaration policy. One is minimum sum insured 2 crores, minimum premium 5,000 rupees. Declarations are made at the agreed interval of time. Adjustment is made at the end of the year, just like open policy, right? Sum insured is based on the previous year turnover. Sum insured should be necessarily previous year turnover. It cannot be less than that. Proposal form is used. Turnover discount. That is, when our turnover is high, you can give the discount. These are all obsolete because the rate itself has gone down so drastically. Right? So this is special declaration policy. Sum insured can be enhanced twice. Sum insured can be enhanced only twice during the current term of the policy. After that, you have to take a new policy only. You cannot enhance the sum insured for the third time. Claim ratio should be less than 60%. Suppose the claim ratio exceeds 60%, next year you have to increase your premium rate so that the ICR is coming less than 60%. You have to charge appropriate premium to make the ICR less than 60%. It cannot be assigned. It can be given only for the certain important clients. So this policy cannot be assigned. Many marine, even though we are saying in general marine policies are freely assignable, some of the marine policies cannot be assigned. This is the one of such policy. Okay. Next, we are going to see two policies. One is duty policy, another one is increased value policy. Right? We have some common features. We will see first, then we'll come to the common features. What is duty policy? Duty policy, what did you understand by duty? It is customs duty. Why customs duty is insured separately? Whenever goods are imported into India, it is subject to customs duty. But each particular good is subject to different rates of customs duty. So when the seller is adding the customs duty to his invoice, the basic policy itself will have a customs duty portion. It is already covered in the sum insured. There is no need to go for a separate customs duty policy. When the seller's invoice don't have a component called customs duty, it is having CEF only, then the goods reach to India. The buyer is going and taking delivery of the goods. Without paying customs duty, he cannot take delivery of the goods. After paying the customs duty, he takes the delivery of the goods and found the goods are damaged. So whatever customs duty he has already paid is lost. So he can take a separate insurance for the customs duty portion alone. Hope you understood. So customs duty portion, who can take? Only the buyer can take. So only for imports we can give the customs duty insurance. Buyer only can take. Right? There are 2 or 3 points you should remember. The rate charged is 75% of the CEF policy rate. There should be this is an add-on policy. you cannot issue a customs duty policy without the basic policy. Basic policy should be there, and rate charged under the basic policy, 70% of that should be charged for customs duty policy. And whenever the goods so received are damaged, the insured can apply to the customs department for a refund of the customs duty paid, stating that the goods delivered are in damaged condition, I cannot use the goods. The customs department may give a refund, but it may not 100%. They give some percentage of the portion of the customs duty already paid to the insured. So whatever claims payable under this policy should be reduced by the refund the insured has received from the customs department. Right? So the important points: customs duty is a add-on policy. Without basic policy, you cannot give a customs duty policy. The perils covered should be identical. Whenever the basic policy claim is payable, then only customs duty policy claim is payable, just like fire and fire LOP policy. The rate chargeable is 70% of the basic policy, and the claim payable will be reduced by the refund received by the insured from the customs department. Right? Then comes to increased value policy. What do you understand by increased value insurance? We have discussed that marine insurance is mainly based on trade. Whenever the goods are on transit, the rate fluctuation is there. The rate may go up or go down. Take the case, an import which is coming from abroad, which may take 2 months or 3 months to reach the destination. The invoice cost is 1 crore. But before the goods reach the destination, the market price for that particular good at the destination has gone up. Yes, on date, the market rate is 1.2 crores. Suppose the goods are lost totally before arrival at destination. The actual loss of the insured is 1 crore only, because that is the amount he is going to pay to the seller. But market rate is 1.2 crores. If the goods has reached in a safe condition, the insured could have sold the goods for 1.2 crores. So his commercial loss is 1.2 crores. His actual loss is 1 crore. His commercial loss is 1.2 crores. We are providing commercial indemnity in marine policy, so we can cover commercial losses also. So we can issue the increased value policy for that 20 lakhs shortfall. Again, this is a add-on policy. There should be a basic policy. The covers given by the basic policies is automatically covered by the increased value policy. Only if there is a claim admissible under the basic policy, claim is admissible under the increased value policy. Right? Okay. The rate chargeable is 100%. In duty policy, it is 70% of the rate. Here, 100% of the rate. Okay. Another thing you should understand, there is no limitation for the number of increased value policies the insured can take. Again, the same example I have given. 1 crore is the invoice value, basic policy is taken. After 15 days or 1 month, the market price has gone up to 1.2 crores. The insured comes to us and taken a increased value policy for 20 lakhs. Even now, the goods have not reached. Another 15 days have gone. Now the market price has gone up to 1.3 crores. So the insured is coming to us again and asking for a second increased value policy, which can be given for 10 lakhs. Because 20 lakhs already covered. Some days again gone, the market price gone up to 1.45 lakh crores. So insured is coming to us and asking for another third policy, insured value, increased value policy for 15 lakhs. We can give. So there are three increased value policies, 20 lakhs, 10 lakhs and 15 lakhs. We have issued, right? After reaching the receipt of the goods, it is found that it is a total loss. But on the date of receipt of the goods, the market price is only 1.25 crores, not as expected by the insured at 1.45. It is only 1.25. So from the basic policy, he will get 1 crore, no issue. It is a total loss. From the first policy, increased value policy of 20 lakhs, how much he will get? And from the second policy, how much he will get? This is the question. Our increased value policy clearly says that in each policy, he will get 75% of the actual loss or 75% of the sum insured, whichever is less. You can put together the first policy and second policy. The sum insured is 20 lakhs plus 10 lakhs. So 30 lakhs is the sum insured available in increased value policies. The actual loss is only 25 lakhs because the market rate on date of receipt is only 1.25 crores, in which 1 crore has already claimed by basic policy. So 25 lakhs is not covered, which should be payable by this increased value policies. He is having enough cover, but we will pay only 75% of the actual loss. Actual loss is here is 25 lakhs, right? So we will pay 75% of the 25 lakhs or 75% of the sum insured. Sum insured is 30 lakhs. When two policies are put together, whichever is less. You can ask a question, why 75%? Each time I am telling, you should know the logic. You should not by heart, you mug up the conditions. If you know the logic, you need not mug up the condition, right? When the goods are on transit, the invoice value is 1 crore. The bill of lading at the source point, they will give us 1 crore only because the invoice cost is 1 crore. So there is a total loss happened. The insurance company can proceed against the ship owner. That is the insurance company having recovery rights only for 1 crore. This increased value policy is issued by us is over and above the invoice value, over and above the amount mentioned in the bill of lading. So we don't have recovery rights for these increased value policies. For any of the increased value policies, we don't have recovery rights. So whenever there is no recovery right, we will pay only 70%. Simple logic. In this case, we have recovery rights only for the basic policy because bill of lading will mention only 1 crore. For remaining amount, we don't have recovery rights. So we will pay 70% only. Hope you understand. Otherwise, ask in the end of the session in the evening. I will explain again. So we have seen two policies, one is custom duty policy and right increased value policy. Both the policies some common features. Both the policies are add-on policies. You should have a basic policy, then only you can take these policies. Coverage should be identical for basic policy and these add-on policies. Only if claim is admissible under the basic policy, claim is admissible under the add-on policy. Only both these policies are only for imports and given to the buyer only. Non-assignable. It cannot be assigned. And other feature you can remember, duty insurance, the rate chargeable is 75% of the policy rate, basic policy rate. But claim payable is 100%. Right? In increased value policy, the rate chargeable is 100% of the basic policy, but claim payable is only 70%. You should note the difference. And both the policies can be termed as strict indemnity policies. Strict indemnity policies, because we are paying only exactly the loss, not even 1 rupee more than that. But basic policy is commercial indemnity policy, where we are paying 110% if chosen by the insured. Right? So please understand the difference. These two policies are very, very important because many questions are asked from these policies many times. Okay. So we will disperse for lunch. We will again assemble by 2 o'clock sharp. Please come by 2 o'clock sharp because we are cover a lot of portion. Okay, thank you.